Hello, folks. Welcome to State of the Market. I am David Russell, Global Head of Market Strategy at TradeStation Group. It's great to be with everyone as always. Interesting Monday here. I'm going to share a few disclosures in the chat. Great to see everyone again. Missed you last week. We had Jimmy Carter, rest in peace, his memorial or his funeral, and we'll be back doing market trends on Thursday afternoons this week. But then next week we won't be doing State of the Market because it's Martin Luther King Day. Pretty interesting. We have had, I think, in the last 5 weeks, I think we've had one complete week. This will be the one complete week. We had Christmas, New Year's, and then all of this Jimmy Carter, Martin Luther King Day. Boom. So one complete week. So, I think we'll just mention off the bat here, S&P 500 might be putting us in a position here where there's a risk of it going green and having a little bit of a potential kind of chase to the upside. So I think we want to just kind of view that as being some potential here. Let me actually just go to my standardized returns to show you guys here. And I'll mention that I did provide the links to our ETF disclosure page if you want to check that out. We do use ETFs here for different kinds of an analytical. These are the standardized returns of some of these ETFs that we are going to talk about. So it is interesting, a lot of negative news in here, and a lot of the levels that we had identified last week have more or less played out. And I think now we're in a situation where there is a lot of bad news. There's really a great deal of negativity that is now in this market. And I think we need to just also kind of realize that. Let's take a quick look here at our key ETFs. I think it's interesting. One thing I did want to point out is basically that we're starting to see more strength now on the value side and on the equal weighted side. If you look over here, as you can see, the Russell today is up more. We're down less than the Nasdaq. There's a little bit of this thing happening. This is a workspace we use in our market trends webinar, and basically it's the market breadth. And what you can see here is there's more stocks here above the 20-day than above the 50-day. But what's really I want to point out here is that RSP is outperforming now on the last 10 days. And that's interesting. That shows we're actually starting to see the equal weighted outperform. Some of the breadth stabilizing and improving. I don't put a huge amount of stock in it overall, but I do think it's interesting because one of the things we were talking about some time ago was the coming weakness in the cyclical stocks that we had talked about a lot. We were wary of things like XLI way back here when it was, look at the weekly. I mean, I just mentioned, we're going to get to it, but I mean, XLI, we were talking about the fact that it was just kind of hanging up here and it was, had that risk of breaking that level, and it did, and it slammed lower. And I think now we're at a spot where a lot of negativity has been kind of priced into this market. And I think now it's more a question of us kind of asking, like, are we at a spot where maybe things try and stabilize? Now, this red arrow shows a bearish outside week last week in the S&P 500. Now, I'm not always sure I place the hugest amount of stock in that pattern per se, because we were in a relatively tight range, and the fact that some of these weeks were have been pretty small ranges, and so having an outside week is not the most consequential thing. It's often more valuable or meaningful at the end of a run. So I think right here, when you've been running one way and you get the bearish outside or bullish outside to signal the reversal of a trend. In this case, we're in a spot where I think we're basically settling into a range here. And my kind of view of the market here in hours is maybe I'd say like how it seems to be kind of materializing is the market has run, it's extended. You can argue that it's overvalued. Maybe it is, but double-digit earnings growth is supposed to start, in the current quarter, as in the news coming out in the next few weeks is supposed to start showing the first double-digit earnings growth since the end of, I think, 2021. And then we're also, at a spot where, you can say it's overvalued, but maybe the earnings catch up. You can say that inflation's getting bad again, but at the same time, this run up we've had in yields, maybe that's all there is to it. So I think we have to realize here is that the market really here, depending on what way things go, in terms of the news, that really can kind of determine which way the market wants to go. And I think we have to realize that there's a spot here where if the news develops in a bad way, we can look back and say, oh, yeah, that was the top. Of course it was the top, blah, blah, blah. But it might also just turn into one of these things where we hold and then it just basically turns into it can't go down, and then suddenly we get an explosive resumption of the upside. So I think that's kind of the way I'm kind of looking at the market here. Now, if you look back to where we were, we did this. If you go to TradeStation.com and you go to Insights, you can actually see some of the things that we've done here. I wanted to very quickly mention, if you follow our blog, there's our article for today, and a lot of the key things in here and kind of I just talked about. But I did this article back last week, and I thought it was interesting because I kind of mentioned the opposite of Goldilocks, and I think this is like kind of the worst case scenario that might or might not happen. But the key thing in here is that there's the risk of rates moving higher and inflation being bad, but at the same time, or inflation being, not terrific, but at the same time, the cyclical parts of the economy don't do well. And that's the one of the things where that could be a worst case scenario where the economy is strong enough to prevent rate cuts, but weak enough to prevent any kind of good, earnings growth, etc. However, the earnings estimates, according to different people who track them, are getting better and still look very positive. So I think we have to just take a step back and just ask which of those things is going to pan out to be correct. We really don't know. But I want to just point this out. This is kind of, I think, the way to think about a real sort of, thing that's in the market. However, I think we have to realize that now a lot of this stuff has kind of played through now that we're down a few percent from the time I wrote this. The other thing I wanted to point out was back. This is my, if you look here also on the blog and you look back at, one or two screens here, we did this webinar. It was the last market trends of last year on the 19th of December, but we very clearly highlighted the risk that was coming in this one on the 19th about the risk of higher yields and stronger dollar. And so, but again, that has now played out. So now we just have to take a step back and really kind of say, all right, so what's really happening next? So now we're going to turn here and look at the S&P 500. I will also just very quickly mention that this week, what we have coming up, we have a bunch of stuff. We basically have PPI tomorrow, wholesale prices, CPI on Wednesday, retail sales on Thursday, and housing data on Friday. It's kind of interesting, but those are a slew of news coming this week. We start to have earnings coming through again this week. And then there's also the JP Morgan Healthcare Conference. It's kind of interesting because healthcare, actually, the thing we're going to look at, might actually be giving us an interesting opportunity here simply because of the fact that a vast amount of negativity is priced in. And one of the real standouts to me that I think remains incredibly interesting is the healthcare industry is showing just monstrous job growth. It is keeping the economy out of recession. The stocks have been trading very poorly. But at the end of the day, we have to realize healthcare is an industry and it is adding tons of workers. It seems to have aggregate demand. There's a lot of positive things that seem to be happening because they're hiring all these people. And I think we have to realize healthcare stocks have not been there. And there might be a certain point in time here when the healthcare stocks can play a certain amount of catch up with the actual things happening in the data. At the same time, we have the healthcare conference this week. JP Morgan Healthcare Conference is the most important healthcare conference probably in the healthcare industry all year, and it's happening this week. So it might create some actual opportunities. There's also a little bit of M&A. I don't actually have them in front of me. There were at least 2 deals this week or today in the healthcare industry. So the other last thing I'll just say is that a lot of bad news is now priced in. Tariffs, that Trump allegedly is going to do in some way, Canada, Mexico, China, etc. Chip rules restricting China, sanctions on Russia and Iran that have pushed up oil. Well, sanctions on Russia and expected, maximum pressure on Iran or whatever that sort of thing. So again, a lot of negativity now is known, and that creates a potential for the pendulum to swing the other way, away from the risk and away from the fear. And I think that's another part of the dynamic here. And then also, if you look at the surveys from things like the American Association of Individual Investors, it has not shown excessive complacency. It has shown actually a lot of fear, real sharp declines in optimism and bullishness, and all those things potentially, could point in an interesting direction. So look at the S&P here. We have a bearish outside week. But I think what's interesting here is the real thing to this week, and you see the rounded top, and all these things are, have a degree of importance. But again, like I said, this is something now where it's, the situation really could be, how does the news pan out? Is the inflation this week hot? Does Trump come through and go totally, hardcore on tariffs right away? Or does he kind of maybe not do something that's quite as bad as people think and then say, wow, they weren't as bad as we expected, or whatever it is. And then before you know it, people start to say that all the news is priced in. So I think that's where we are right now. The key thing to me here is that you can now see that this is something of a range, and then the question is, does it resolve, up to the upside or downside? And that's what we're going to watch to see. But I think the thing you see technically here is we're essentially holding this range on the weekly. But the thing that I think is interesting is on the daily. So if we look at the SPX on the daily chart here, we see two things. First of all, this level from November 5th, the election day, we went down and we held the close from election day. I think the other thing is we have to see if the market closes, even green, the slightest bit green, this turns into, I'm not sure the name of this pattern, but I've seen this pattern before when you gap down and then you come fighting back like this, kind of like this when you basically hold early, in a sell-off day, people more or less buy near the open and the sellers never get follow through. I don't know if it even has a name, but I've seen this pattern before when things gap down and then they fail to hold there and they basically come back to being slightly green or little changed. And it's often something you see at the bottom of a sort of intermediate term pullback. And so I think right here we could be seeing that. We also have this channel coming down here. So at this point in time, we have some things that are, kind of giving us a sense that this might be a spot where people want to see something of a bounce. We might also want to see something of a push back toward the 50-day moving average, back toward 5,900. I've been watching a few different levels here, and one level that stood out to me was it was a level up here. Let me just at this point, I think we're in a range, and I'm not even sure really of the levels above where we are. What matters is we're holding the level from election day. This low here, I think now actually I'm going to take it off my chart because at this point, it's kind of not as relevant. Now we kind of know that we have this range, and I'm going to take this level off my chart as well because I'm not sure at this point. If anything, the level that now matters, I'm going to move this up to the all-time high because if anything, this is the range now I think people are kind of more cognizant of. There might be some levels up here. We had this big reversal day from the Fed here back over 6,000. So I think at this time, from my view here, the thing is we're holding the bottom of this range with a lot of bad news priced in. We have the downward channel and we also have this close. Those are the two things that matter, I think on this chart. Now we look at the Qs. It's a very similar. Let's go to the weekly now. Most of the stuff we do in this webinar, we look at the weekly charts of the big indexes. And again, so I think here, the one that kind of stands out to me, it does remain this high from the summer, and we are above it and around 496. And I think, again, we're just kind of sitting in this range. And the question is, if the news is positive, this turns into a tight range. It then could suddenly have, a rip to the upside. If the news is bad, then it just can accelerate down to the, through here. So I think that's really this chart at this point doesn't give us anything really. We have a bearish outside week, but what was it? It was just people were excited. They slammed it down and they're waiting for the news. We don't have the news yet in terms of earnings and things like that. So, not going to, it did not want to give us a breakout follow through before the earnings. And at the same time, last week we had these, these ugly data points. The Institute for Supply Management had these price indexes were running hot, and that's what bothered people. So at this point, this is to me something that just says that we're holding and waiting. The Dow, last week we highlighted this level as being the level that people might test, and it did. So I think that's why we're seeing right now the outperformance in the value, the industrials, the financials. So this is now, I think, an important level, and this might be something where people look for. This is, I think, if anything, the beginnings of a sign of things having reached a level where they might struggle to move further to the downside. To me, this is a key thing that this is holding, and I think at this point, this is actually something now that kind of tells me that the overall market might have actually kind of achieved a lot of its real, follow through to the downside at this point. The Russell, we also were mentioning that this level from October could be in play, and now it is. And I think also we have to watch and see here, if news is not that bad, this might be something that turns into a reversal to the upside relatively quickly. And so I think this is something also here where, again, it's going to be based on the data. Do things push higher? And it's going to be based on the 10-year Treasury yield, which we have here. And, to me, this remains the most important chart. Now, when I look at this thing over the longer term, what stands out to me at the 10-year is, I don't have it in front of me. I'm not going to pull it up now. But if you look on the if you look on, well, actually, I can pull it up. I have a second. Fred curve. This is the curve. This is basically the 10-year Treasury yield. This is the yield curve. So historically, the yield curve between the twos and the tens have been something. Let's just say 100. This one line here is 100 basis points, right? So it's been essentially over the longer run looking for the twos to tens to return to 100 basis points is a relatively, middle of the road expectation. It's not a terrible baseline expectation to have. It is often been far above 100 basis points. So if it goes back to 100 basis points, you're basically the 10-year going up to 5.25. So we have this level around 5, and I think that is something here that remains the bigger thing. If things get more on the bearish side, this level from 5.25 actually does go back here in 2006 and 2007. So if you look here, 2006 and 2007, that was an actual high. So we're not just also making that number up, based on the curve. There's long-term levels there, and it also makes sense based on the curve if you look for the curve to go to 100 basis points. So that's something I think people might have out there. But again, we have inflation coming this week, and these numbers are relatively, if the numbers are not terribly high, we might end up in a scenario where basically it doesn't do much more to the upside. So I think we have to realize here that, again, the numbers are what matter. There is still space, you could argue, in this going to the upside. However, at this point, the Fed is no longer hiking. And if the data ends up being not terrible, then we're in a spot where you don't get that. Now, the other thing I think is important to realize is, we do have a lot of negativity. So the situation in China, a lot of the stuff that's been happening globally does not point toward yields going significantly higher. So I think right now, from what we've seen in energy, we're going to get to this, but a lot of this stuff is now pushed in one direction. And if we suddenly have the sense, oh, tariffs aren't going to be so bad, inflation isn't so bad, this could be something where the yields more or less stall and the market can then stabilize. And over the long run, we might still talk about yields going to 5%, but it might not be in the next month or two. And if it's not in the next month or two, that could be something where maybe we get an earnings rally for earnings season and things come strong, and then people come back and get hawkish again, in terms of looking, further out in time. So at this point, it's done a lot, and longer term, it does. There are reasons to talk about 5.25 on this, or going back to 5. But near term, I think we also have to realize, again, this is going to be based on what the data gives us this week. I don't have much to say about materials. We had talked about the kind of weakness here, and this is something of a range down here. From my perspective, if we close above this high, from back here, this is also something that people might look for it to run back up toward, above 87 on the XLB. Again, this is going to be entirely based on what the data wants to give us. This has pulled back a lot. There's really no clear support here or anything, but it is trying to stabilize at this level. And if we get a little bit of dovishness, a little bit of softness after several weeks of hawkishness, then this could be something that we see a rebound up toward 87. I will just look at the dollar index. We don't normally look at it, but I will just mention here that the dollar index has kind of broken out, and people, again, can be looking up to this level. But again, in the near term, it could easily have a pullback for a few weeks and still be in an uptrend. It's like the same thing as a 10-year Treasury yield here. So yes, we can see upside in these DXY and TNX, but it doesn't mean that it's going to remain in the next week or two. Now, communications is the one that we have said has, in some ways, the cleanest chart, and I think that remains the case. Here we are back to this level from it was basically the weekly low, in middle of November, and I think right here, this is also one that had a bearish outside week, but it is, holding these levels. It really has not had a lot of breakthrough to the downside. It's trying to get back into that candle, and communications remains kind of, from my view, technically, in some ways, the cleanest of all these stocks in terms of just a clearer potential view of an uptrend. Now, energy has had a really strong bounce. Again, I mean, they've thrown a lot of stuff at energy with Biden coming out with these latest sanctions and things in terms of Russian things and everything else. And I think there's an expectation now that Trump is going to put sanctions on Iran. So those things are kind of, lifting energy. But there's a spot here, again, when that news is priced in. If you look here, this moves to the downside. We're more or less retraced half of it. There's a 50% retracement here. So I think we're at a spot where, people might want to be watching and waiting and still viewing energy as more of a downside trade. If we basically are able to just kind of if this becomes a 50-day moving average as well, this level, that more or less point out around that 50% retracement of this entire range, it could take several sessions to kind of stall and stabilize here. But this could be something where if it sits and pauses for a period of several days, people might look for this to return to be a downside trade. Overall, the XLE has been, really staggering here, and there's still a lot of reasons globally to be concerned about it. I think that the Chinese situation is something that we've been talking about for a long time, and that's really something where um, there's not a lot of real reason to have hope about China somehow recovering quickly. It doesn't seem like they have a very clear policy solution to it. And so I think right now we're in a spot where the secular forces that have weighed on energy could reassert themselves, and these kind of shorter term forces based on tariffs and sanctions and stuff, those might be things of more limited impact and not, they're kind of just one off. Once they're done, I think my understanding is Biden he basically did the maximum sanctions now against Russia. So the thing is it might not have that much more, and we might see the pendulum swing the other way. And I think at this point, energy is something people might still be thinking about more on the downside. If we see a little bit of kind of pausing and somewhere between 90 and 91 on the XLE, a few sessions from now, maybe next week, people might come back more on the negative side. So financials here, we were we were looking at financials last week and also noticing that it had this kind of big bearish candle that it broke down to the bottom of. And again, this is something now with earnings starting with these guys next week. I think here we have to realize that there is some potential here down to 46 and a half. There's also a lot of messiness now with the situation, the California fires in Los Angeles, because some of the biggest financials is Berkshire Hathaway, which owns Geico, and you have there's definitely a property and casualty aspect to financials here. So I'm not really sure what to make of these. The banks are reporting and stuff. So I would just mention here at this point that, there might be some potential down to 46 and a half, and that might be kind of what people look for on this. Again, it will be highly dependent on the data, the inflation data. Now, this is interesting. Look at this pullback in industrials. What, 2, 3, 4, 5, 6 weeks down in a row, and now it's starting to stabilize. So to me, this is actually kind of interesting. This level here from middle of September. I think this is something now where people might actually start to look for industrials to start to stabilize. We have been warning about this kind of risk of it breaking this support, and it did. But now we're at a spot where it's starting to stabilize at a pretty discernible low. I mean, this is pretty close to the high in the summer, and now it was a low. There's a high in August, a low in mid-September. There's a lot of price action here around 130 on the XLI, and this might actually be something people now look for, kind of holding and becoming support. XLK, I think there's another one where it might have the potential to hit this level from late October down around 222. Again, this is something where when you actually look at it, it has not pulled back that much. And it's just kind of sitting here, but this is the level where people might want to be active down at that kind of that low. I think it's here. It doesn't have a lot of really clear sort of opportunities like sitting right here in this range. There's just continue to be more and more negative news on Apple. Now, one that is kind of interesting here, in terms of the pullback, is now maybe consumer staples. These have pulled back to a pretty significant area, and I think at this point here, this might actually be an area where people want to get more active. If you look at the XLP here, we're back to some levels from, like, for example, in early 2020, in the middle, like July of 2023, and then these lows back here in last summer of May and July of 2024. So I want to kind of point that out because XLP is now back down to a level where if people were playing the downside, they might at least be looking to get out of it, and be neutral on it after this decent move to the downside. There are earnings in some of the big names like Procter and Gamble and Coca-Cola. Those guys are relatively soon, and so I think that that's something to think about in XLP. Now, the real estate investment trust, again, very interest rate sensitive, but also nothing really here that's very clear in terms of support. This is something that people might really look for this to move closer down toward 38 or even lower. I mean, this was like an important level where it consolidated, held, and rallied. and that might be where people look down for some kind of test and support. Now, utilities are also muddied by the situation in California. There's two big utility stocks, Edison International and Pacific Gas and Electric, or whatever it's called. I feel like there's these two big ones, and you can read about it. They both have exposure to this fire. It's very unclear. I don't want to really try and figure out what's happening with that. I do think, though, in utilities, though, people might actually be thinking about the secular story in these and just kind of realizing that this is kind of emerging as a new area that went from being boring to being something of an AI related sort of play. And so I think this is something where if we have a sense of interest rates kind of stabilizing, this could be something where people really look for some opportunity. However, I do think we should also realize here, I'm going to move this level to here because I think at this point, something in this range is really where we should be looking, down around 72 and a half. The reason, if you go all the way back to December of 2022 and then the high last May, it was also a low back here before they broke out. So this might be the level that, say we get a hot inflation report, say yields do spike higher, this might be the spot where people want to get more active. It might just need to grind down toward that sort of area. Utilities are not maybe going to be the thing that are most active around earnings, but this could be something where people want to just realize that there is an increasing secular growth story in utilities, and they're not nearly as kind of boring as they once were. Now, XLV is, I think, in some ways the most interesting that we see now. It held this level from last April, and what's interesting to me about XLV, like I mentioned, the JP Morgan Healthcare Conference, and I don't want to get too much into geopolitics. There's a lot of negativity now in the healthcare industry, and there's also, the House of Representatives is like 50-50. So, there might be a situation here where we just get a whole bunch of nothing out of the House. And and nothing can be a pretty cool hand. Maybe if you know Cool Hand Luke, but the interesting thing I think is that there's been a big expectation of bad stuff happening to healthcare, and a lot of that is now priced in. And so I think with earnings season and everything else coming up, these guys might not be as bad as people think, and these could be an area that surprises to the upside where there's been so much negativity. And so I think that people might want to, this is actually something I think that is kind of interesting. And I still think, despite what everyone says, people have to remember that healthcare is a secular growth area. It is the strongest part of the economy in terms of job growth. It has not trickled through to the earnings side, but there is definitely activity with people going to hospitals, getting procedures done, all the sort of stuff that actually leads to volume of business. And so I think right here, this is something where a lot of negativity has now been priced in, and it's holding a level that is potentially support here. So you could even look over here. You could kind of move this line and you can look there. It's kind of this high from July of 23, but there's some areas across here where it seems to be kind of holding. I'm also curious, what if we do a Fibonacci retracement of this? That's a 50%, but look at that. It's not, that's more than a 50% retracement. So, I wouldn't put too much stock in something that has that much of a time frame as well. But I think the key thing is a lot of negativity is now priced in, and we actually look at the data, like I mentioned with the housing, with the jobs data, and it actually has been something that has not, it has been the strongest part of the economy. Consumer discretionaries here, I think, is also kind of another one that is maybe the most also very interesting. We had mentioned pullback to 215, but we got pretty close to it. And so I think right here, if you look at this level, this was this high, mid-November. Then we went back and held it late November, right around 219. This might be something here where, look how it chopped down under that low, chopped down, and now it's green. So of all the things I'm looking at here, consumer discretionary, communications, and healthcare might be the ones that have kind of, the clearest sort of opportunity. And then at the same time, something that if it can kind of hold and the data is not terrible, the industrials might be something in some way that kind of, come to life here. So those are the main things I'm looking at today. We'll be back on Thursday for market trends. Let me just make sure I'm not missing anything else. Get my notes real quick. Yeah, those are the main things I want to cover, and I will see you guys on Thursday. Have a great week.